Hello, everyone, and welcome to another edition of the Money Pros. I'm Oliver Tutt, certified financial planner practitioner, and I'm going to be your host for the next half hour as we talk about the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. We've got a great show in store for you today. We're going to be talking about a bunch of things. One of them is financial literacy, which is ultimately what this show is all about, is hopefully improving folks' financial literacy. But there's a recent study, academic study that's come out that puts some numbers to the importance of financial literacy. We also have the results of a survey of where Rhode Island ranks in terms of overall financial literacy among the 50 states. So we're going to talk about that. We also have our financial planning Money Pro, Rob Auclair, certified financial planner with Randall Financial Group. He's going to be joining us in a little bit, and we're going to be talking about investment expenses and the importance of understanding them as you take a look at your portfolio. Stock market is at a record high right now as of the recording of this show. S&P, Dow, pretty much any measure that you look at is at or near a high. We're going to be talking about whether you should be getting in, getting out, or doing nothing. We're going to have the answers to that. And finally, as part of the segment on financial literacy, we're going to have a quiz question for you, do a little mini quiz of exactly how our audience's financial literacy is. Hopefully, if you're a watcher of the Money Pros on a regular basis, it's pretty good. So we're gonna check it out. But first up, there's a study that just came out a few months ago. It's interesting because it's an academic study of financial literacy. It was done by a couple of professors. One, University of Pennsylvania, Wharton. The other one at George Washington University. They got together. They did a study. The title of the study is The Economic Importance of Financial Literacy. So what they're trying to do is they're trying to quantify how important it is for a population to be financially literate and some of the problems that they can run into. And as part of the study, they designed a 3-question quiz that they asked a number of participants to assess how good literacy was among the study population that they were looking at, which was men and women throughout the United States. They developed a 3-question quiz. Unfortunately, only 30% of Americans surveyed could answer all 3 questions correctly. And as I alluded to earlier, at the end of the show, I'm going to give you one of those questions. I'll give you the answer too, but you'll see, at least for one of those questions, which is all we have time for, how you do with that. So it's important to note that this study really determined that overall financial literacy, people's understanding of basic financial concepts wasn't where it needed to be. But the study went beyond that to take a look at what some of the problems of not being financially literate were. And what they found is that people that are not financially literate tend to make bad financial choices. Examples were the use of more revolving credit, like credit cards, spending in excess of earnings, which of course is a recipe ultimately for disaster, and the use of high-interest loans and payday lenders. So definitely traits that are not healthy from a financial standpoint. Next thing I want to show you is a ranking from a website called Wallet Hub, and they looked at all 50 states plus the District of Columbia to look at the rankings of most and least financially literate states. So I have the bottom of the barrel, if you will, here. Coming in at number 49 is Nevada. I'm sure the fact that Las Vegas is located there has no bearing on that statistic. Number 50 was Arkansas. Number 51 was Mississippi. Where did Rhode Island fall? Unfortunately, not too great, number 46. So toward the bottom of the list in terms of financial literacy for the state of Rhode Island. They looked at a number of factors with respect to that study I don't have time to get into, but I thought it was interesting. It certainly caught my attention, sadly, when I saw Rhode Island at the end of the list. So, question, what can you do to help improve financial literacy? And I think a lot of it has to do with children. If you've got kids, talk to your kids about money. It's critical that they understand and they see you making financial decisions and that they understand concepts like interest, buying things now versus deferring purchases toward later, the concepts towards savings. The next one, discussing your own financial decisions with them. Don't be afraid to have a conversation in front of them about the financial decisions you make. They want you to put in a pool, have a conversation with them about what that costs versus other things that they may not think are important right now, like going to college or other financial goals that the household might have. And finally, empower them to make some financial decisions. They've got to have some money so that they can make their own financial decisions and choices about what's important to them. All right, that's all we've got for that. Up next, Rob Auclair, certified financial planner, Randall Financial Group. We're going to be talking fees and expenses, so stay tuned. There's more to come here on the Money Pros. Welcome back to the Money Pros. We're joined now by Rob Auclair, certified financial planner and my partner at Randall Financial Group, and also our financial planning Money Pro. Rob, good to have you back on the show as always.
Thank you again.
So I think today we're talking about a particularly important topic, and that is fees and expenses. Now, it might not be the most exciting topic when it comes to investments, fundamental analysis of what the next great company is going to be or something like that, but it's really critically important. So let's start off by talking a little bit about why understanding what the cost of investments, why is it so important? I mean, sure, it's a cost, but is it a big deal, I guess is what I'm asking.
It is a big deal, and I can prove that to you in a second, but I think we all kind of get caught up in what things cost in an everyday life, and so, we wouldn't go pay 20% more for something that we know we can get for $1. We wouldn't go pay $1.20. So the recognition of when it comes to your investments, just forgetting about it and letting it happen is really now something you need to pay attention to. You should have paid attention to it before, but it's more and more media driven of saying, hey, we need to be transparent with these investments, and such small amounts over time become very, very big amounts of money that you could have saved. So, and a lot of times what ends up happening with these is people don't even know. They might be getting a 10% return in a given year, and if they really looked at it, they really had a 12% return, but the expenses might have been 12 in that case.
Right.
And so I think we have a slide that kind of shows you just a quick example here. It showed that if you actually had about $100,000 20 years ago, that it would, in 20 years at 6.5%, accumulate to $350,000, and just 1% more at 7.5% is almost $75,000 more.
Goes up to $424,000. So that,
correct.
I think there's some interesting things about that graph that stand out to me. One is that difference of 1%, if somebody were to do just quick math and say $100,000, 1%, that's $1,000.
Right.
Maybe over 20 years, maybe that's $20,000. That's still real money. But the difference is actually $75,000.
Over 20 years. And think about it, I'm not, $100,000 is a lot, but say you got $250,000, this gap of dollars just gets bigger and bigger and bigger. It's time to now pay attention. And so hopefully what I can do is explain some of the things that you should be looking for in these expenses, and then be able to make an educated decision.
But I think you make a good point. I just want to get back to it quickly to reinforce why this is important. I mean, people will cut coupons to save 25 cents on a roll of toilet paper. They will drive across town to save 5 cents on a gallon of gas. But when you're looking at an expense that over 20 years could cost you $75,000, don't you find that a lot of people just aren't paying attention?
Correct, and part of it is just the way it's presented to you. Boring, thick books, most of the time prospectuses. So
well, we didn't promise it was going to be exciting, right? All right, but we can't save them some money or make them some money, which is what the point of this show is all about. So let's try to break down some of the expenses. And the first, if you think about the life cycle of having an investment, the first part of having an investment is acquiring it, purchasing it, right? So there are a variety of things we can buy, from stocks and bonds, mutual funds, 401ks, So what are some of the costs associated with the acquisition of various investments that we should be familiar with?
Right. So let's first take like stocks and bonds, and basically you can go online and you can open up a brokerage account or an IRA and go and make a trade. And what you're going to get is a cost to make that transaction. So it's a transactional cost. If you do it on your own, you do it online, I mean, it varies a little bit in price, but you're roughly somewhere around $10 or so. Mm-hmm. However, sometimes you might need help from a broker, and you might actually have to go, call the brokerage house. You go and do that, you could be looking at $45 or $50 for that transaction.
For a full service brokerage firm.
Correct.
And the services that they would provide, essentially.
And then another tidbit just to kind of know about is if you get into like an IPO, a lot of people said, oh, buy Facebook, buy Google, whatever it may be. It's no longer a small transactional charge. It's a pretty big percentage of what your investment is. So, it's 3%, I think about 4.5% of whatever you put in.
So you've got those upfront costs.
Right, so that's transactional. Then we can, and by the way, there's a lot of different ones. These are the most common ones.
Sure, absolutely.
The other one could be, you paying a commission to actually purchase this. And so the three most common ways in which you pay commission is if you had an investment, let's take a mutual fund, for example, which is made up of a group of different stocks. They can be bought in A, B, or C shares. They're the same exact investment. The A share can charge up to 5.75% up front.
Okay.
And what that means is you go and put $10,000 in, take away $575, you now have $9,425 invested.
That's what you'll see in your account. The other money was taken,
It's gone right off the top.
And who got that money?
A lot of different people. So I mean, usually what it is, it's it's a commission going to the broker that sold it to you for the majority of it or all of it. The other thing is, you got a B share, and what that is that 5.75 stretched over a 5 or a 7 year period. So it's a way to kind of defer the charge over time. And then a C share is 1% annually, not to infinity, but for a pretty long period of time. So I think what we need to realize here is there are upfront costs to acquiring this. There are ways to kind of do it on your own, and you can kind of get away from that, but in most cases, people are purchasing these not even knowing about it. I'll take a look at someone's statement, and they're like, I have no idea I paid 5.75. And so it's the awareness of that, it's reading the fine print.
All right, so you have the transaction and commission costs related with the acquisition, but that's not where the expense ends. Kind of like a house. You pay the real estate agent potentially, but that doesn't mean the expense of the house is over. There are other things. So let's talk about the next life cycle of the investment, which is the ownership of the investment. What are the costs I need to worry about there? Isn't it kind of over at that point?
Well, I mean, for stocks and bonds, and many times it is over. You're paying only about the point you're buying and selling.
Yep.
But let's go back to that mutual fund for a second. You've now actually employed someone, whether you knew it or not, to manage that mutual fund. Inside there, it's their specialty to buy and sell the stocks.
Some companies making decisions about what's in there, what's not in there.
Mr. Smith is the manager. He's got people underneath him, so he's got operational, administrative expenses. So he's paying for people possibly to travel and say, hey, is this going to be a good investment for us to buy this company? He's paying for administration, software, place they have to stay. Well, guess what? That expense gets passed along to you.
Do I see it taken out of my account?
No,
though?
remember what we said in the beginning, like let's just take the example of these administrative expenses, I would say average somewhere around 0.5% to 1%, all depends. And so if you got a 10% return and it was 0.5%, you really had a 10.5% return.
Right.
So you're not seeing it unless you read that prospectus.
So like in the example of the graph we had up earlier, the investor actually got 6.5, and that was because it could have been because their investment expenses were 1%. The underlying investment earned 7.5.
Right.
Expenses brought it down to 6.5.
It's your job as the consumer to uncover your expenses.
So not only was that $75,000 expensive, but it was silent. You never realized you paid it, right?
Correct.
Okay.
There is a second expense under mutual funds, and they call them 12B1 fees, and it's really the way in which the mutual fund is either getting distributed, so advisors going out there, and then for ongoing service, so that if they need to do some stuff there.
All right, so we're running out of time. I want to get to charges that would be associated with finally selling the investment. Quickly, what are some of the costs that we need to worry about there?
Okay, so one of the bigger ones would just be actually selling your stock or bond or whatever. There's going to be a transactional charge like there was in the beginning.
Right.
Go to that B share for the mutual fund. If you haven't completed the 5 years you, in a sense, promised when you said, I want to buy a B share, and you're halfway through, if you had $100,000 and you invested that, and now you've got 2 years left, you're going to pay 2%. That's $2,000 just to get out. From an annuity standpoint,
similar deal with annuities, right?
correct.
It's, if
but
you get out
usually
too
you see
early,
these charges much bigger. Sometimes people get annuities that are 10-year annuities. Halfway through, they want to get out on $100,000, $5,000 to get rid of it and get your money free.
these are basically penalties for not holding on to the investment long
Correct.
enough. So you
Read the
really have
fine
to
print.
be cognizant of those. All right, so are these expenses just something we have to put up with, or are there things that investors can do to lower expenses, to consciously avoid these costs? What are some suggestions there?
First thing would be, if you want this mutual fund or this investment, read that prospectus. Find some good resources to say, is this worth what I'm going to get? However, the other thing, and really the industry is kind of moving in this direction, is something called exchange traded funds. I always on this show talk about asset allocation. Large cap, mid cap, small cap,
yeah.
how much should we have in each? Well, instead of buying a mutual fund, you can now buy an index in a sense. So if I say I need $10,000 in my large cap value, I can go buy the S&P 500 large cap value.
And how much can something like that save you potentially?
So a normal mutual fund might cost you 1%. This might cost you 25 basis points. You just save 75.
0.75%. That's going to go right in your pocket.
Yep.
All right, I don't want to rush through this, but I do want to make sure that we get to some resources for investors to help them better understand. We've got about a minute left. So the first one up there is mutual fund or annuity prospectuses. That should be the go-to place, right?
This is the big book you're going to get in the mail every time you make an investment. It comes out quarterly. Nobody wants to look at
Dull
it.
as dirt.
Got to look at it. Usually
But by law, it's got all the information
You got
in there,
it.
right? What are some of the easier ways to find out information?
Well, next one up on the board we look here is Morningstar.com. There's a paid version and a free version. Here's a way in which you just enter your ticker symbol in and it'll give you some information.
Easily digestible. What's another one? FINRA.org. What's that?
FINRA is a nonprofit organization, and that you can just actually plug in, again, your ticker, and there's an analyzer there. Totally
Tell you what
third
the
party, give you
expenses
the
are.
expenses, rates of return, so on
And
and
finally
so
on
forth.
401ks, which is something a lot of people have to understand the expenses there.
Go to your website,
Gotta
click
go to
on the
website.
fund.
All right, we're going to hold you there, Rob. Thank you very much. An important conversation. All right, up next, stock market is flying high. What should you be doing? We're going to have the answers coming up. Stay tuned to the Money Pros. All right, welcome back to the Money Pros. So as of the taping of this show, we're taping it on July 16th, so you're going to see it over the next couple of weeks. But as of right now, stock markets are at an all-time high. And while I try not to get too worked up about this stuff, we'd be remiss if we didn't talk about it and maybe some of the things you need to consider as you look at where the market is and where your investments or potential investments are as you make decisions. Because in my experience, when markets are at an all-time high, that's where I find people make some of their worst investment decisions. So if we can help you avoid some of that, let's do that. But before we do that, let's take a look at the numbers. We'll use the S&P 500 index, which is a common measure of stock market levels. And here are the performance numbers. Year-to-date 2014, just half a year, we're up 7.39%. Last 12 months, going back to last summer, up 22.22%. And since March of 2009, why March of 2009? Because that is when the market started to recover from the financial crisis and recession that we had. Since then, the market is up nearly 200%. That means your money doubled twice if you were smart enough to have it in at the bottom, and I sincerely hope you were smart enough to do that. So what should you do? Some of you in the audience are thinking, I can't possibly get into the market now. Why would I get in at an all-time high? Others of you are thinking, God, I'm in, I got to get out because I'm afraid I'm going to lose my shirt. You're both wrong, okay? Here's what you need to be doing. Let's take a look at some of the tips here. First, consider your time horizon. If you need any of this money that's invested inside of 5 years, it doesn't belong in the market. Sell and take care of any needs you have within 5 years. And that doesn't mean if you're retiring within 5 years. You don't need all that money the day you retire. Retirements last 20 or 30 years, but we're talking about home purchases, supplementing income, things like that you're going to need inside of 5 years. Shouldn't be in the market. But if your time horizon is longer than 5 years, don't sweat it. Next, rebalance your portfolio. All right, should you take your money out of the market, put it in right now? No, the issue is you got to look at your mix of stocks and bonds. And since stocks have done so much better than bonds over the past 5 years, what you're going to find in your portfolio is that if you started, as an example, with a 50-50 mix of stocks and bonds, if you haven't touched it in 5 years, you now have probably a 60-40 or a 70-30 mix of stocks and bonds. That is a recipe for a problem when the market inevitably corrects, which it always does. We just don't know when, right? That's the problem we have. So consider rebalancing your portfolio. Does that mean getting out of stocks and getting into bonds? Not exactly. It just means reducing the percentage of your portfolio back down to your target. So if your original starting point was 50-50 and you're up to 70-30, you got to sell off 20% of the stocks and put that money in bonds. The beauty of this strategy is it doesn't require any timing at all. If you do this on an annual basis, regardless of where markets are, and you always rebalance, you will force yourself into doing exactly what investors should always be doing, which is selling high and buying low. If you unload stocks right now and buy bonds, you'll be selling stocks high and buying bonds low. But you don't do it with your entire portfolio. You simply shift back to your target asset allocation. Finally, what if you have money sitting on the sidelines that's long-term money, it's out farther than 5 years, but you are nervous about the fact that the market is at an all-time high? Should you wait a month? Should you wait 6 months? Should you wait a year? The answer is, I don't know. If I had a crystal ball, I probably wouldn't be doing the show. We'd be doing something entirely different. But because we don't know, because we don't have a crystal ball, use a strategy called dollar cost averaging. It's not exciting, but it's effective. If you have $100,000 that you want to invest and you don't want to put it in all at once because you're afraid we're at a market peak, why don't you put it in $10,000 at a time over the next 10 months as a strategy? That way, if the market declines, you'll buy more shares of that mutual fund or that stock if the market goes down, and if the market continues to go up, you'll buy fewer shares. But at least you'll be utilizing a strategy that will lower your average cost. It's not a guarantee of positive returns, but it averages out the timing error. If right now turns out to be a bad time, you will have averaged out your timing error. If right now turns out to be a good time, you're going to take advantage of that too. All right, up next, we're going to have a pop quiz question for you on financial literacy, so stay tuned. We've got more to come here on the Money Pros.